What's up, traders? So today I'm going to show you an option strategy that I have used to help me reach retirement in my 30s. And not only will I show you the strategy, I'll also show you a potential trade. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market. And I use the money that I make from the stock market in order to pay for my entire lifestyle. Now, before we get started, of course, please hit the like button and also subscribe to the channel. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I built wealth over time. Now, options trading has absolutely been a blessing to me throughout the years. With those not familiar with my story, a little over a decade ago, I was working at a job making $10 an hour. And throughout the years, I aggressively saved, and I ended up saving up enough to open up my own ice cream parlor. And the business did amazing, and after a few years, we opened up a second location. And the second location was set to have its grand opening in March of 2020. And obviously, we all know what happened during that time, which was the pandemic. And so just as I finished dishing out tens of thousands of dollars to get the second location open, I not only had to delay the opening of that location, but I also needed to close down the first location as well, effectively brought my income down to $0. And because during that time, none of us knew how long that this would actually last, I was in a really bad position. And because I have a wife and 6 kids, yes, I said 6 kids, I knew that I had to go out and figure out a way to make money. And that is when I stumbled into options trading, and it literally saved me. And over those last 5 years, I've developed my own framework when it comes to trading options. And I'm currently 36, but by the age of 34, it put me in position that if I wanted to, I could go ahead and call it a career, because I know that the cash that I have is generating me enough income that I would not be able to outspend it. And that has been a huge blessing, but that's enough of my story. Let's get down to the strategy. Now, if you don't know anything else about options trading, you probably know that you buy a call when you think that a price is going up, and then you buy a put when you think that a price is going down. And while you can get amazing returns doing so, most people do it wrong. And the thing with buying calls and puts is you have a very low probability of profit. And if you want to increase your probability of profit, you want to come over to the selling side. You want to sell puts and sell calls. And that is because you have a very high probability of profit. And the reason for this is because you can be wrong on the direction of the stock and still make a lot of money. And secondly, as time moves on, it works in your favor. Whereas when you use buying strategies, you need the stock to move in a specific direction, and you need it to do it quickly as time is working against you. And let me show you what I mean. Selling puts is like selling insurance, but instead of for a car, it's for stocks. And you're simply agreeing to buy the shares of the stock if the stock price were to crash below the price that you agreed upon. And if the stock doesn't crash, you just keep the money you were paid. But if it does, you still keep the money you were paid. You just need to purchase the shares. Just like your car insurance company keeps the money you pay them every single month, whether you get into a crash or you don't. However, 99% of the time, you don't get into a crash. And so here's a real example. And here's how selling puts would work. So let's say we have Apple stock, which is currently trading for $165. What we could do is we could sell a put at, let's say, $150. And we could set this contract to good for 30 days, which is our expiration date. And for doing so, we received $200, which is our premium. And so moving forward, we can look at this chart here. And so we have Apple stock, which is currently at $165. And so if the stock were to go up, we just keep that $200 we received. If the stock price stays the same, we just keep the $200 we received. And if the stock goes down some, we still keep that $200 we received. However, if it drops below 150, we've agreed to buy 100 shares of the company per contract that we have. However, for us, this is a win-win because we have selected a stock that we would like to own, and we selected a strike price that we would like to own it at. So with selling puts, you essentially either get paid to wait around, or you get paid to wait around and buy a stock that you like at a cheaper price. And that is literally a win-win. But now let's look at selling calls. All right, so now let's say we own the shares of Apple, and now we want to sell covered calls. So let's assume Apple's price is $165. What we can do is set our strike price at anywhere above the price that we paid for the shares. So in this case, we'll do $185. And we'll keep the expiration to 30 days out, and we receive $200 for selling this contract. Well, if we look over here, if the stock price just stays at $165, then we keep the $200 premium that we received. If the stock were to move up to $185, then we still keep that $200 of premium we received. And if the stock price were to go above $185, then we still keep that $200 of premium we received. However, we agree to sell the shares of Apple at the $185 mark. So that is where we will limit our capital appreciation. So if we bought Apple stock at $165 and we sold covered calls at $185, we would get all that capital appreciation from Apple moving up from $165 to $185. However, we capped our profits at $185. So you'll get that $20 capital appreciation, and you'll also get the $200 of premium that you receive from selling the covered calls. But again, we will be fine with that because we were fine with selling the shares of that company at the strike price that we selected. So that is selling puts and selling calls. However, what happens when you combine both of them at the exact same time on the exact same stock? When you combine selling puts and selling calls at the same time, you get what's called a short strangle. And with a short strangle, what you want is for the stock price to stay in between your sold put and your sold call. And from this situation, you can collect premium from both sides of the trade. And here's a quick example of that. So let's say Apple stock price is now currently trading for $175. What we could do is we could sell a put at $165 and we can sell a call at $185. And we'll keep the expiration to 30 days out. And now we received $400 in premium. And if we look over here, what we want is for Apple stock price just to stay within that range that we set. And as long as it stays within that range, then you just keep that $400 in premium and you go about your day. However, if it moves outside of the range in either direction, that's when it can become a losing trade. However, I'll show you what to do in that situation and how to make sure that this trade is the highest probability of profit that you can get. Now, the next question is, if we are going to sell short strangles, then what companies should we do them on? And the answer to that question is you shouldn't do it with any individual company. I personally only do this trade with ETFs. And I pretty much only do this trade with ETFs that either follow the S&P 500 or that follow the NASDAQ 100. And if we look here, I kind of group it into two different categories of people. So one, if you have a decent sized account and or you prefer not to buy the shares of the company, then I would use ETFs SPY, which follows the S&P 500, or the QQQ, which follows the NASDAQ 100. And the reason it's better to use ETFs than it is to use individual stocks is because these large market-based ETFs tend to move much smaller than what individual stocks move. Okay, and for example, Tesla can move 20% on any given day. However, for the S&P 500 and NASDAQ 100, if it moves 1 or 2% in a single day, that's considered a pretty large move. Albeit we've had a lot of those moves lately, but that's a whole different story and I'm not going to get into that. All right, but if you fit into this category, then SPY or QQQ is an excellent choice. And then on the flip side, we have people who do not have large accounts and or they are just fine with buying the shares of the stock. And for this, I use leveraged ETFs like UPRO and TQQQ. Now with leveraged ETFs, they tend to move 2 to 3 times more than the stock or sector that they follow. And so for this example, both UPRO and TQQQ are triple leveraged ETFs. And so if the sector that they follow moves 1% up for the day, then they will look to move up 3% for the day. And then the same works in reverse. If the sector that they follow were to move down 1% for the day, then these ETFs will move down 3% for the day. And this does a few things. One, because they are more volatile, they tend to come with about 3 times the premium as the sectors that they follow. And secondly, it can be great for smaller accounts because they are both about 1/10 of the price of the sector that they follow. All right, both SPY and QQQ are around $400, $500, whereas UPRO is around $50 and TQQQ is around $40-something. And so you don't need as much money in your account in order to trade these. All right, so these are the ETFs that I like to use for short strangles. Now, could you use individual stocks in order to do a short strangle? You absolutely could. And being honest, all of 2022, I did this on Tesla the entire year. And I collected several hundreds of thousands of dollars that year just from doing short strangles on Tesla. And it worked out great for me. Now, in hindsight, I look back like, oh, that was pretty stupid. That was pretty risky. It did work out for me, but now that I have a much, much larger account, it's much safer doing it with market-based ETFs. But now that we have all that information, let's head on over to Thinkorswim and look at a potential trade. All right, so now we are at the options chain for QQQ, which is the ETF that follows the NASDAQ 100. And the next thing we need to do is select our expiration date. Now, typically, I always stay within expiration date of up to 45 days. However, when the VIX is elevated like it is now, I will go all the way up to 90 days in order just to lock in the premium. All right, so the VIX is around 30 as of the date of this recording, but anytime it's above 20 is considered to be very, very high. So I'm going to select a little further out expiration date in order just to lock in the premium, because I'll be exiting the trade once I get around 50% profit anyway. So we'll come down here. So like I said, we typically go within 45 days. So I probably would have selected this 43-day expiration, but let's go a little further out. Let's just do 64 days. So about a 2-month expiration. So I'll select that. And now I want to look at 2 different data points. So the first thing I want to look at is the expected move. So if we come over here to the right, we'll see this plus minus number here, but we can see it says plus or minus $51.43 currently. So that is the largest move that the option market currently has priced in for QQQ for this expiration date. And so I want to make sure to select strikes that are beyond the expected move. So I'll be selecting strikes that are more than $51 below 445 and more than $51 above 445, since that is the current price of QQQ. Now, the second thing I want to look at is the delta. Now, the delta tells you how much the premium will move per a $1 move in the underlying stock's price. And so at a delta of, let's say, 0.20, it is saying that the premiums will move 20 cents per a $1 move in QQQ. However, most successful traders look at the delta as the probability of the event occurring. So at a 0.20 delta, that is telling me that there's a 20% chance that QQQ drops down to this strike by that expiration date. Or in other words, you have about an 80% probability of profit. Now, when I'm doing the short strangle specifically, I like to go down to a delta of 0.10. And I'm fine with doing this because I know that I'll be collecting premium from both sides of the trade instead of just one. So I want to be even more conservative. So if we come over to the 0.10 delta, it looks like we have a strike of $364.78. And currently that is paying anywhere between $3.86 to $3.93. All right, and for those new to options, that is the price you'll be paid per share, because every contract is worth 100 shares. So you'll receive 100 times the amount that you see. So if I were to just sell a put right here, right now at this strike, I would get 100 times the amount that you see. All right, but let's go ahead and select that strike. So we can just come over here and select the bid price. And for selling that put, we will receive about $394. But since we're doing a short strangle, we need to go ahead and select our short call as well. So I'll scroll down here and the same thing. I want to come to about a 0.10 delta. So that looks like I would do about the $510 strike. So I'll go ahead and select that as well. And so collectively, we would receive about $565 per contract for placing this trade. So what I want to do next is select the amount of contracts that I want to do. Now, there's absolutely nothing wrong with just doing one contract at one time. And my little saying is one contract a day will keep the poverty away. However, for the purposes of this video, let's say we're going to do about 5 contracts. All right. So 5 contracts on either side, and we will receive about $2,800, give or take, right here, right now for placing this trade. Now, what I like to do is stagger my entries. So maybe I'll place this trade today, and then in 2 more days, I'll place another trade, and then 2 more days, I'll place another trade. And while I'm doing that, I also select different expiration dates and different strike prices. And eventually you have it set up to where you're making money on either side of the trade almost every single day, which ends up being several thousands of dollars per month. But now let's head down to the profit and loss chart. All right, so we can see here where this red line is, that is where QQQ's stock price is currently. And we literally just need for it to stay within this large range that we've already set. And that's a pretty large range as well. So it would need to move more than 20% downwards for this to be a losing trade. And it would have to move up, let's see, what about 15% upwards for it to start to become a losing trade. And so that's what makes this such a high probability trade. And if you look at this number right up here, you can see that as long as it stays within that range, we just keep that $2,850 that we received. However, if it were to move outside of the range in either direction, you can see we will start to lose money. And we can see that on either end of the trade. Now, how do you get out of the trade if the trade starts to go against you? Well, there's 2 different ways. One is you can set a stop loss. And I would typically set my stop loss to about 3 times the premium received. And that'll have you good to go. And that would be more for people who do not have large accounts and or for people who do not want to buy the shares of QQQ. However, how I like to do it is I am fine with buying the shares. And so if the stock price were to go downwards, then I would just accept assignment and then turn around and sell covered calls on it. Because I know that I am buying a total market ETF that will go up over long periods of time. And then on the flip side, if it were to go up and I seen that it was threatening my strike price, I would just go ahead and buy the shares of QQQ in order to make that position covered. Because at that point, it becomes a covered call. And I'm able to do that because this is a market-based ETF. So the chances of it moving up 15% in a single day is very, very slim. Whereas if it was a single stock, then that could happen on any given day. But doing that option would be more for people with very large accounts, because since our strike is $510, that would be roughly $50,000 that you're buying per contract of QQQ. But what if you don't have that size of an account and you still would like to trade this in a way that you are fine with buying the shares? Well, that is where the leveraged ETFs come in. So now let's look at a very similar trade using TQQQ. So now we're here at the options chain for TQQQ, and let's do the exact same trade. So we still want to select the exact same expiration date, which was 64 days out from now. And for our put, we want to go with a delta of about 0.10. So it looks like we have a 0.09 and a 0.11. So we'll go ahead with the 0.11, which will be the strike of 28. So we'll go ahead and select that. And now we need to select our call strike. So same thing, and that'll put us at a strike of about $67. And so we'll go ahead and select that as well. And at the mid price, we will receive about $194 per contract that we have. And so let's just go ahead and select 5 contracts, just like we did with QQQ. All right. And we will receive about $1,000 right here, right now for placing this trade. And I would do the exact same thing. I would do entries on different days, at different expirations, and at different strikes. And that typically will result in several thousands of dollars per month. And in this case, because TQQQ is only $44, it's much more cash efficient to buy the shares of the company if it were to drop or rise to either of our strike prices. All right, but you could still use a stop loss if you want to. However, when I trade these, I am just ready and willing to just buy the shares of the company either way. So let's go ahead and look at the profit and loss chart as well. All right, so we still have that very wide range. Here is TQQQ right here, trading at $44. And as long as it stays between that $28 mark and the $67 mark that we set, we just make our money and we go about our day. However, if it were to move outside of our range in either direction, then we are ready to do one of the 2 exiting strategies. But 9 times out of 10, this is just a winning trade. We have a 90% probability of profit, and that is what I like to see. And this is one of the strategies that I've used in order for me to retire in my 30s. Now, if you know anyone who is looking to generate income off the cash that they already have, then tell them about the Trade to Freedom community. The link is in the description below, but not only will they get my exact trades when I enter them, but they'll also get my entire options framework via the Trade to Freedom course. They'll get full access to ask me questions at any given time. And then lastly, they'll be within a community of other traders that all have the exact same goals as them. So if you know anybody at all, the link is in the description below. Go ahead and send it to them so they can start generating income off the cash that they have. Well, I hope you learned something in this video. That's it for this one. I will see you guys on the next one. Peace.